Hi there, welcome to kneppyinvests. I had planned on doing an Appendix 4C December quarter video for AI Media. However, the company did release their first half results for financial year 22 on February the 23rd. And there were quite a few interesting things within this results announcement. In particular, the company did give some guidance for financial year 22. It was their first guidance at this point in time for the financial year 22. And the reason that is interesting is because back in November, we did see the share price fall about 40%. Not because the company changed guidance, because they didn't have any guidance. It was because an analyst, a Morgan Financial analyst, actually decreased their guidance for the company in regards to revenue and EBITDA. And we are able to see how well that analysis did because we can compare now the guidance from that analysis to the company's guidance. And I'll be doing that or comparing those two guidances in this video today to see also if the share price, a drop of 40%, is justified. Was that the right move by the market? Should we have trusted the change in guidance from that analyst? Just a few facts in regards to AI Media. This company was founded by someone who was deaf, and they just did not believe there were enough things out there to help deaf people in terms of captioning, transcription, and translation services. So he, along with some other people, began AI Media back in 2003. The company listed on the ASX 15th of September 2020, so that's about 18 months ago. The CEO and co-founder, Tony Abrahams, he has a 13.3% holding, which is the largest holding in the company. A few other interesting shareholders include Regal Funds, 4.7% holding, and WH Soul Pattinson, 3.4%. That does interest me. Whenever I see WH Soul Pattinson have a stake in a company, I tend to want to research that company because that is a fine company. They're one of the only few companies on the ASX, maybe the only company, that has increased their dividends over the past 30 or 40 years. Now, the markup of AI Media at a share price of 61 cents is 128 million. That markup was significantly higher before that change in guidance from the analysis when the share price was well over $1. And the ticker code for AI Media is AIM. Now, let's just start off with a chart to the middle of November because I just want to show you how the market reacted to this change in guidance, sort of a downgrade to guidance by this analysis. So usually you'll find a downgrade or profit downgrade usually done by a company, not an analysis. And it was a little bit surprising to me to see the market take this downgrade from the analysis quite harshly. So the share price fell 20% on the day this report was released and then fell another 11% the next day and then closed at about 70 cents. But the share price has continued to fall from there. So the market has become a little bit more pessimistic in regards to AI Media. Fairly negative sentiment around this company right now, just off the back of this change in guidance from Morgan Financial Analyst. AI Media did respond to that change in guidance from Morgan Financial, and this was a change in guidance. So originally Morgan Financial had guidance for company's revenue, which was about 70.5 million, and they also had revenue in regards to EBITDA, which was 9.6 million. And then on November 12, they released a report downgrading revenue from 70.5 million to 61.6 million and EBITDA from 9.6 million to 0.6 million. So that is a significant change in guidance from Morgan Financial, and the market did listen. That's why the share price was punished and why AI Media actually responded to this report from the Morgan Financial. Now, AI Media also mentioned they have not released or published earnings guidance for financial year 22, which is really interesting that Morgan Financial had, well, I won't say had, but they believe they had a better notion on how the company was going to perform over the first half of this year than what the management of AI Media had at that point in time. So that really surprised me that, particularly if they were going to be right, Morgan Financial, that they had more insight on how this company was performing. The company would not typically comment on the contents of a research report. However, the company believes that the research report had a material impact on the trading in the company shares on ASX on 15th of November 2021. It definitely did, with the share price, not only on that day, the next day as well, with the share price falling from $1 to 70 cents. Now let's have a look at the first half year results for Half Media comparing to the first half of financial year 21. Revenue increased from 22.7 million to 29.6 million. And the most important part here is the change or increase in gross margins. In fact, gross margins improved by 15% from last year up to 53%. And I'll be talking about this not only in this slide, but also the next few slides, how this is really important for this company and why AI Media is looking quite attractive right now. Now, because of this increase in margins, this company has gone from being highly operational cash flow negative and unprofitable to being operational cash flow positive and profitable. In fact, the operational cash flow has gone from $13.8 million negative to positive $2 million, and profitability has gone from loss-making of $8 million to profitable by $188,000. The company also has net cash, no debt if I remember correctly, but net cash of $16 million. Now, where it becomes really interesting is the margins in some of their revenue streams. For instance, in the largest revenue stream, services, margins in that is only 40%. If you take a look at SaaS and hardware, significantly higher margins. SaaS revenue has 75% margins, hardware revenue has 70% margin. So why is that important? Well, and this also explains why the company's financials have improved significantly from 1 year ago. So 1 year ago, services revenue accounted for 79% of total revenue for the company, and that has decreased to 73% in this year. SaaS revenue has increased from 9% to 12%, and hardware revenue has increased from 9% to 14%. So there is a shift from how this company gets its revenue, and there's less reliant on services and more reliance on SaaS and hardware. And if that continues over the next few years, this company will increase their profitability because those margins will keep going up. And if they can keep increasing their revenue, there is potential this company will become highly profitable. Something else I found interesting in their half-year results in their presentation was where geographically the revenue is coming from. And there are three areas they mentioned here: Australia, New Zealand, North America, and rest of the world. And the best performing geographic region was North America, where revenue did grow 56% from 10.3 to 16 million. However, in the comments, they did say North America growth driven by EEG acquisition. So there is potential. There was not much organic growth there. But in the rest of the world comment, they did say rest of the world growth driven by new customer wins. So fairly interesting comments there. So not necessarily, even though revenue in North America did increase by 56%, not necessarily the company is growing quite well there. It's just they did make an acquisition, and that did affect revenue growth in that area of the world. But by far, the most intriguing part of their financial year or half-year results presentation and announcement was that the company did provide financial year 22 guidance. And now we can compare their guidance to Morgan Financial guidance and see how well Morgan Financial actually did in their change in guidance. And here is AI Media's guidance. First guidance for financial year 22, and they're looking at, talking about revenue, gross margins, and EBITDA. So that's two of the things that Morgan Financial were talking about in their changing guidance report on, was it November the 12th? And remember, Morgan Financial guidance in regards to revenue was 61.6 million, and AI Media's new full first guidance for the year is between 60 and 62 million. So Morgan Financial was smack dab, not quite in the middle of that revenue guidance from AI Media. Gross margins expected to be between 53 and 54%, significantly higher than last year, which was 42%. And they haven't given a number in regards to EBITDA, but they are saying it's going to be positive. And Morgan Financial also had positive, but that was only 0.6 million. So that Morgan Financial report that did downgrade AI Media's revenue and EBITDA was absolutely correct. So I don't know who that analysis was from Morgan Financial, but they did an absolutely stellar job. They know the inner workings of this company. It's still surprising to me that they are able to release a report about 3 or 4 months before AI Media's first guidance for the financial year. Now, originally, I was going to do an Appendix 4C video for AI Media, and I've just kept this slide that was supposed to be in that original video in this video, simply because this is looking at receipts history through time. And this is one of the things I do look at for all companies that release Appendix 4Cs, and also companies that release half-year and full-year results. But those companies, I'm only looking at half-year and yearly timeframes. With companies that do release Appendix 4Cs, we're looking at quarterly timeframes, and I do like to look at that time frames. Anyway, AI Media's receipts have been growing through time. This is exactly what we want to see for a possible investable company, and they've grown receipts from $9 million in the September quarter 2020 to $16.3 million in the most recent quarter. Now, the rise or the growth in receipts is not smooth, because 2 quarters ago was their record quarter in terms of receipts, $17.9 million. But there could be a little bit of seasonality within this company. I don't know. So preferably, I'd like to see at least 8 quarters or 2 years of receipts to see if there is any seasonality in a company. Now let's look at the updated chart for AI Media. This does not include trading on the 24th of February. I'm recording this video just after open. Well, a few hours after open anyway. And last time I looked, the market was down 2.5%. And AI Media's share price was down about 4%, which is not surprising. However, the market did respond to the half-year report quite well, because the share price was up about 12%. Now, in saying that, even though we did get that increase in share price, the share price has been dropping ever since that report from Morgan Financial. In fact, it's decreased from $1 to a current share price of 61 cents. Even after those first 2 big down days, where the share price did finish at 70 cents, the share price has continued from there. So there's a lot of overhanging resistance with AI Media. So there's a lot of people who have bought in at higher share prices. So there's going to be a lot of investors, if you can call them that, or shareholders of AI Media who consider this company to be a dog stock, because when you do invest in a company, this is sort of the new thinking, when you invest in a company, you want the share price to increase almost immediately. If the share price decreases, it's a dog stock. And whenever you think a company is a dog stock, you want to get out. But you don't want to make too much of a loss. So you're going to wait when the share price pops up or starts to increase, and that's when you sell. And that's what will probably happen for AI Media over the next few months. If we do see the share price starting to turn, there's going to be a lot of resistance. A lot of these shareholders who want to sell out. That's all about psychology. Psychology is very important when you're talking about investing or speculating. So even though I really like this report from AI Media in regards to the increase in margins, and I think there is potential, the margins in this company will increase over the next few years, we can remain patient. Just wait till all this overhanging resistance, all those shareholders who want to sell out have sold out. And as soon as that happens, there will be no resistance for the share price to move higher. That could play out over a few months, even a few years. So we can remain patient. Just wait for a signal for a shift in sentiment, a signal in terms of a trend in the share price. And hopefully that shift will coincide with some good financial news from the company. That's all I have for this video on AI Media's first half of financial year 22. And it does look interesting, this company. In particular, those margins have potential to increase quite a bit over the next few years, particularly if they keep focusing on SaaS and hardware revenue-derived areas. And even though there is a little bit of negative sentiment and there is definite downtrend in the share price, we can remain patient, because it might take a little bit of time for that negative sentiment to turn, for the share price to move into an uptrend. And hopefully, when we do see that shifts in both sentiment and the trend in the share price, that will coincide with some really good financial news from the company. Up until then, I'm remaining on the sidelines, but I definitely have this company on my watch list. If you have any questions about AI Media, leave it in the comment section of this video. Otherwise, I am not a financial planner. If you do need financial help, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.